Appreciate that. And I think this presentation is certainly in the vein that we all just talked about in terms of furthering education and deeper understanding of this product and some of the innovations we're seeing in the marketplace. So I'll start here. Good afternoon, Mr. Chairman, Commission staff, and members of the Agricultural Advisory Committee. Thank you for the opportunity to speak with you today. My name is Liam Smith. I'm the Chief Strategy Officer at Optiver. I'm speaking today on behalf of the Principal Traders Group, otherwise known as PTG. By way of background, PTG is an association of principal trading firms that trade their own capital in derivatives, securities, and digital assets worldwide. As a group, our members are key providers of liquidity, market depth, and price discovery across global commodities and financial markets. At Optiver, we've been making markets and managing risk across global derivatives for 40 years. Our role as a market maker is simple. We quote continuous two-sided prices so that commercial hedgers, institutional investors, and end users can transfer risk efficiently whenever they need to. I'm joining you today to discuss a derivative structure that has seen notable growth across global markets, perpetual futures. Our goal for this session is strictly educational. As financial innovation moves into new asset classes, our objective is to break down how these products work under the hood, demystify the mechanics, and provide a clear, practical foundation so you can form your own conclusion about their place in the derivative landscape. For market participants, perpetual futures can offer real structural efficiencies, and at the same time, they introduce unique market dynamics around continuous margin management, 24/7 trading cycles, funding rate volatility that requires really thoughtful evaluation. We aren't here to advocate for a specific outcome. Rather, we want to walk through these mechanics step by step, how funding functions, how liquidity behaves, and how risk is managed in practice. Thank you again for the invitation, and I look forward to the questions at the end so we can continue the discussion. And thanks, Emma, for hopping along there. So real quick, before we even jump into what is perpetual futures, I think we really wanted to start with hitting on some key terms, talking about the contract structure, and then obviously really focusing in on what I'll call the index and then the funding rates. And I think that's where we really want to spend a lot of time with everyone and make sure you walk away understanding what that is and how it functions and how it works. I think we do want to touch on some of the other features that kind of come along with this product, including the auto-liquidation. And obviously just discuss some of the features where you do hear a lot about 24/7. I think this is all important information for this group holistically, and I think we're very open to making sure you have a deep understanding of the product. So as you can see here on the first slide, I don't want to read it line for line, but as you can see, exactly what is a perpetual future? It's a derivative contract with no expiration. And I think a lot of people ask about what does that happen? Effectively, everything gets cash settled, in terms of getting in and out of that position. It's something that's actually been around for the 90s. I think the big thing to understand, Yale professor Robert Shiller came up with it as more of a way to measure illiquid assets back then. And it's really found a market fit in today's market, especially in digital assets, mainly in offshore venues. And I think that's another area we want to also spend some time about what's actually being happening onshore. When you hear that, we're talking about the US versus offshore, which is non-regulated in the US. And so the big step here, and that's come up here, is in May of this year, the CFTC approved the first onshore US perpetual future, starting in Bitcoin. And I think the big thing here is also this group understands convergence, and it's an important part of the marketplace. And what we keep kind of talking about is this funding rate. And I'll use something Matt Cashman had said to me about where is the, people are saying, oh, there's no more risk because there's no more convergence. I think it's key to understand the risk has moved into the funding rate, and that's what you need to understand in terms of that, the market structure and the fit and the construction of the product. And so that's what kind of replaces that convergence in the market structure. So if we can move to the next slide, please. Just going to touch on a few terms to make sure we're all speaking the same language. Starting with the index price, I think what we want to say there is that's effectively often a benchmark in the digital asset space that's often used by referencing a number of spot markets in terms of how it comes up with the index price that the perpetual future will reference. I think that it's something to be noted. I think you'll see a lot of this is digital asset. The market is moving forward. I want to be on it, like on top of the fact that there's also looking at some of the other assets. I think there's a gold perpetual that's currently being evaluated and filed. But so I think the thing here is this market that we're talking about on digital assets often is really looking at spot exchanges to come up with that index price and kind of uses a number of different smoothing techniques to come up with a price that represents the spot market in there. Kind of jumping then really to the most important piece on here is the funding rate. And I think it's important to understand that it's a periodic payment. In most of these products we see it, it's on an 8-hour cycle. So I think it's key to note that there's often 3 of them throughout a day's trading. And I certainly, can highlight, obviously, as we talk about 24/7, that's where this becomes very important in terms of monitoring this. And the idea of the funding rate, it's not there to tell you the price of Bitcoin or direct you in the direction of Bitcoin. It's there, again, to play that role of keeping it in lockstep with what is the index price in terms of moving around in terms of that. And so it's key to note, this is also not an exchange fee. This is a payment across when things trade above it, either a premium or a discount. In terms of that payment that going across of the funding rate, that's obviously longs go to shorts when it's at a premium and vice versa when there's a discount. I think moving to the next slide quickly. Again, what does it actually look like onshore here in the US, and kind of where does it seem familiar? Where does it start to diverge? So I think in terms of what we see today, crypto assets, certainly a discussion around what assets make sense next, asset classes that is. But you see it facilitated through the traditional model, the FCM, the DCM, the DCO model, things that we're familiar with in the traditional futures market. Is there leverage available? Absolutely. You can see this is a snapshot of what the current leverage is on a number of the contracts that are available. Here, this is where does it start to diverge? The 24 hours trading, that's where you start to have a conversation around the trading hours. The funding mechanism, making sure people understand where that funding mechanism is. And then liquidation is another area where it has a nuance that we want to make sure people understand this. Moving to the next slide. And I think this is where we'll spend a bit of time. So as we said, right, these never expire in terms of that. And so when you go about this, and there's an example on the next slide, but effectively what we want to say here is when the index price is calculated, again, using multiple spot exchanges to come up with that price, it is compared to the perpetual future. So that's what it's referencing back to. And then the measurement of that, of where that's trading, is it trading in step with it, or is it trading at a premium or a discount? And that's, again, where we want you to understand in terms of the future moves around that index price or it stays in lockstep. What happens then is, depending on where it goes in those periodic payment windows, is where the discussion happens on, again, if it's a premium, longs to shorts, vice versa for discounts, and that funding flow happens, again, between market participants, not to the exchange. And again, and then the theory is, with this, and I tried to talk about it, I put it at the bottom, it's really the rubber band theory. The idea is, the further thing the perpetual future moves in terms of either to a premium or a discount, there's then an economic kind of incentive for somebody to come in and push that back into line with the index price. And so many of these groups that we've seen so far often have a cap on the 8 hours kind of window that we're talking about. It's often around 2%. I think so then people need to understand, again, that could be up to 6% in a 24-hour cycle. It could also be 0 in a 24-hour cycle. And so I think that as the things move around, the idea of this funding rate is to try to push things back to what we'll call fair value, which is the index price of the actual underlying exposure there on that piece. Heading to the next one, just to give a real quick explanation in terms of using some real numbers. I understand Bitcoin's not trading at 100,000. I think the thing here I would say is, so in one of the baseline examples here, you have Bitcoin and the index price is currently saying it is valued at $100,000. If we were to open a long position effectively at 10,000 notional on that position in perpetual futures, effectively this would happen here. Heavy buying potentially could push the perpetual future into a premium structure. As you can see here, as I mentioned at the bottom, the Bitcoin perpetual is currently now at 101. The index price is still at 100, if that makes sense. What happens then at the end of a funding window that we were just talking about? As you can see, it's finished above there in a premium. There's a funding rate of 1%. The longs will pay the short. What does that actually mean in terms of an example of that $10,000 position? I would move $100 to the short. Again, that's not including, that's not an exchange fee, that's not a spread. That is just a funding example of where people need to understand of where the funding rate mechanics happen. As you can see, all the groups that kind of offer this certainly put out the math behind how they're doing it and determining the premium or discount, how often they observe the product and what their observation periods are, and then the average of the premiums. And I think, again, it's something, if these are products that somebody wants to look at, you should deeply understand how those are calculated and when they're calculated. Moving on to auto liquidation, I think, again, we want to kind of touch upon that. Though we reference the traditional model, FCM, DCM, DCO, I think here, again, we want to make sure people are understanding what does auto liquidation actually mean and what's that process. And I think that, the commission has certainly taken a conservative approach, which I think is a good move in terms of this, in terms of the leverage available and things like that. And the reason I say that is because in a very simple walkthrough of what happens, it's just like a traditional market. You have an initial margin, you have maintenance margin. And if you've opened a position, if that position moves against you and you reach that maintenance margin ratio effectively, what happens then in that process? All of your orders are immediately canceled. Any open orders, I should say, that you have there. The liquidation engine currently then will look to do a market order often to the market, not the last traded price, which I think, again, is important to note in terms of closing out the position. And then obviously always the question is, if there's a residual loss, who pays? And I think the idea is that by managing it in a conservative method like that, we hopefully don't end up with anyone with a negative balance in their account, is the goal of having that kind of market structure there. I think like anything else, if there was, they certainly follow the more traditional guarantee fund that you see that's a hallmark of U.S. market structure and the exchange structure there. I think going to the next slide, just to kind of give an example, because again, I think you hear a lot of different things and a lot of headlines. Again, we're just kind of spelling that out in the bottom line of what does this look like, in terms of a DCO, default waterfall guarantee fund, in terms of standard structure, in terms of there. I think we're not looking to kind of focus too much, I would say, on the offshore venues that you see there across the board. But as you can see, it is a very different structure in terms of how they go about managing these auto liquidation feature. You'll also hear about auto deleveraging with the many of the offshore venues. Again, I highlight that as this a different feature from what we're seeing here currently in the U.S. offering. Moving to the next one, please. I think a quick comparison too in terms of what's the same product, onshore versus offshore. And so you'll see, and when you see the things like a centralized exchange versus a decentralized exchange, I think it's important to note again, what do we have here in the US? We've got a centralized exchange, again, that many of the groups here operate. Where is it maybe start to see a little bit different? You see leverage is very different offshore from what's currently offered onshore today, which is a meaningful number in difference there. When does this happen? We're certainly talking about an 8-hour cycle here in the US today, but certainly other groups offshore run it even shorter or continuous. And then as you can see here really is like what product is currently offered in this. And you can see certainly that groups offshore today offer things outside of digital assets across FX, indices, gold, oil, and then even stocks at times. And I think today it's meaningfully to note it's crypto currently. I think that there's a meaningful conversation around what other assets make sense for the commission to hear, but certainly something that's in the near front here to figure out. Running to the summary slide on the end, please. Again, I think this is I know I went through it pretty quickly. I'm happy to talk to anyone. Also, I think we're happy to share the slides if anyone's interested in those. But I think the big thing is really understanding it's a new type of derivative contract. And I think that the big thing that we wanted you to walk away from is understanding the funding mechanism in terms of why is that so important, especially to the construction of a perpetual future. Really looking at terms of, again, why is it important? And obviously approved today, what does it look like in the future? And I think, talking about, Ed's kind of started that conversation earlier of obviously what asset classes make sense. Is it filling gaps? And making sure that people understand what that product is, and is it providing the hedge or the exposure that you're looking for versus the traditional future is a worthwhile conversation. And with that, again, appreciate everyone making the time. Hopefully was able to impart a little bit of understanding in the product, and again, very happy to discuss it further.